we did the going concern principle. We were discussing what are the accounting principles. So the last we did was going concern. Next is the monetary unit principle. So monetary unit principle, according to this principle, business transactions should be recorded only when they can be expressed as currency, right? So when we cannot record any business transaction which cannot be expressed in monetary unit in terms of rupees for India country, right? Then we cannot record these transactions. Accountants should avoid recording non-quantifiable entities in the financial accounts. Whenever a transaction or an event occurs, it is first converted into money. So for example, we are having the sale of our units, right? So they can be accounted in rupees, so we will be recording them, right? Only those transactions which can be quantified in terms of rupees can be recorded. After that, it is recorded in the financial accounts of a business. It ensures that every accounting record is measurable in monetary terms by currencies, right? So whatever transaction is being occurred, that can be quantified, that can be recorded in monetary terms. Only those transactions have value in accounting. They will be recorded, classified, and interpreted in accounts, right? So this is monetary unit principle. I will repeat, monetary unit principle means all those transactions which can be quantified, which can be recorded in terms of money, they will be recorded. Now let's go to the next principle, reliability principle. This principle ensures that every transaction, business activity, event, etc. is reliable when presented in the financial statement, right? So all those transactions which are reliable and relevant, means irrelevant transactions do not have place in the accounts. Reliable means those which have particular source of evidence. Like for example, I'm purchasing certain raw materials from my supplier. I'm having the receipt that I have made the payment to the supplier. So that has a particular evidence. That purchase entry has a particular evidence. I will have my purchase order also. So those transactions which can be verified with the proof of evidence, those are reliable and relevant. So reliability principle means that all those transactions which are reliable, which are relevant, which can be verified with the source of evidence, that can be recorded in finance, that can be recorded in accounts. Information should be associated with objective evidence, and it can be checked, reviewed, and verified. This makes the information more reliable. Along with this, the information should be accurate and have a transparent representation, right? So there is a transparency. We have proof, we have source of evidence, right? And then we can record it. We can match the transaction with the source of evidence. This makes the information reliable for its users. This principle ensures every financial statement and business accounting records are accurate. So reliability principle means that only those transactions which can be verified with the source of evidence, they can be verified, that should be recorded in account, right? That means that they are accurate and they have actually happened in the financial year. Now we will move to the next principle, time period principle. This principle ensures that every transaction, business activity, event, etc. is reliable when presented in the financial statement. Information should be associated with objective evidence and it can be checked, reviewed, and verified, right? So time period principle means that the principle that whatever transactions are being recorded, they are occurring during that financial year, right? It is from, we know the financial year takes from 1st April to 31st March. Most of the companies follow this rule. So time period principle means whatever transactions are being occurred during this period, during this financial period, they will hold place in the financial statements. Any payment, any income that is due after 31st March will be recorded in next financial year. So we basically take a period of 12 months, right? Now we move to the next principle, revenue recognition principle. Now, what is revenue recognition principle? Revenue recognition is a part of GAAP that states revenue is recognized when a critical event has occurred, right? So revenue recognition, I'll just brief you out before explaining further. Revenue recognition means whenever revenue has occurred, whenever that transaction has occurred. Remember the accrual accounting of accrual principle means whenever the event has occurred, we should record in that accounting period. For example, if I am making sales in January and the payment is due in April, so I will record in the previous financial year from 1st April to 31st March, right? So whenever the transaction is occurred, whenever the revenue is occurred, we should recognize in that particular period, in that particular month. So this principle uses the accrual method of accounting, that is when revenue is earned. According to this, revenues are recognized when realized and earned. It is a straightforward principle. Revenue is recognized whenever customer make payments. So I can just brief out again. There are two ways to recognize the principle. Number one, if I am making sales in January, I will be recording the revenue in January. Though the payment is received in February, March, April, whatever month it is received, I will record in January only. This is as per the accrual method of accounting. Now, this is one way. That payment is not received as and when revenue is occurred. Second is when payment is being made side by side. When customers are making payment as and when the sale transaction is being occurred, then also we will record the revenue. For example, I'm making sales in February, getting the cash payments or check payments that are received in February only, we will record the revenue in February, right? So if cash payment is received, well and good. If it is not received, it is received later, but we are incurring the revenue in the month of February, we will record in February, right? Whenever the production takes longer, the accounting for revenue becomes more complicated, right? Why there is complication when production takes longer? This is because production is taking the time period maybe 6 months. So the company is difficult to say when is the raw material converted into work in progress into the final product, when that final product will be sold. So if it will take very much longer, maybe year, maybe 6 months, it is very difficult to relate that final product and its sales, right? So this is revenue recognition principle. Next is objectivity principle. Now this is a very important principle. This says whenever we are recording the transaction, it should have an object, right? The objective should be related with the aim, the goal of the organization. Now let us read what does that mean. It refers to the concept of considering financial statements as solid evidence. These statements should not be biased or opinionated, right? So I'm saying objectivity principle means that whenever we are preparing financial statements, the statement should not be biased. It should not deteriorate the motive of the organization, right? The motive of the organization is to say earning profits by selling, say, apples, right? So this objective should be considered and it should be followed while recording the transactions. All transactions should revolve around this aim or this goal, right? And who can make biasness? The accountants can make biasness while recording the transaction. So there should not be biasness, there should not be opinions, there should not be manipulations while recording the transactions. While constructing the financial statements, these statements should be helpful in evaluating the financial results, financial position, and cash flow of an entity. So when constructing these financial statements, they should put me up to a particular stage. They should help me in evaluating what is the financial result. Evaluating the financial result means whether the company is earning profits or is going towards losses or is going to achieve some point, right? Maybe when we say when the new business has been started, there is a point called where profits are equal to losses. First, the company incurs losses, they achieve a point, right? Where profits are equal to losses. So we are evaluating the financial results, the financial position, where the company has actually reached, whether it is in the introduction stage, it is in the growing stage, it has reached the maturity, right? And what is the cash flow of the entity? Cash flow means the company might be earning good profits, but it is possible that the cash flow is not very good. The company should have inflow and outflow of cash. That makes the company a better company, right? That the company has income and outgoing of, basically we're interested in income of cash flow. This principle of accounting must be from the viewpoint of an auditor as well. In case an auditor is auditing a business that he has worked with, then the audit report might not be free from bias as per the relationship with the business owner, right? So whenever we are preparing the financial transactions, it should be from the point of view of the auditor also, because the auditor is the one who will check whether the company is doing as per what it is required, whether they are being fair to themselves, to the stakeholders, to the government, to the society, right? So obviously when you're preparing the accounts that are presented, that are as per the audit norms, they can easily interpret and easily understand what is the financial result of the company. So objectivity principle means that whenever we are preparing the financial statements, it should be free from bias and opinions, right? Let's move to the, okay, we are done with the accounting principles, right? Now there are certain limitations of these accounting principles. We were studying these accounting principles just to see that whenever we are recording the financial transactions, whenever we are making accounts, whenever we are making trading, profit and loss account, balance sheet, we should follow these norms. We should follow these principles before recording, before identifying, recording, classifying, and interpreting the financial transactions. Now, there are certain limitations. Whenever we have these principles, we have limitations too. Now, let's see what are the limitations. These financial recordings are measured in monetary value, due to which the significant events that are not monetary in nature are not accounted for. Right? We have monetary unit principle. We have mostly principles saying those transactions which can be recorded in monetary unit hold value in financial statements. But what about non-monetary transactions? For example, whenever we are changing the board of directors team, right? See, board of directors guide the company, right? And they are the most important members of the company. They tell you what to do, where the company will go, in which direction the company will, right? So they take certain decisions which put value to the company, right? They take certain decisions like maybe related to investment, maybe related to some contribution to the society, which will change the value, which will make the company more valuable in the society and to the stakeholders. But those quality transactions, those decisions taken by them, which cannot be recorded in monetary unit, does not find any place in these financial statements, but they are important to be recorded. So this is the limitation, number one limitation of accounting principle, that certain non-monetary, very important transactions that cannot be recorded in monetary unit, that cannot be recorded in currency, are not recorded in the accounting not recorded in the accounting statements, right? Second is, accounting principles are maintained as per the historical cost and are treated as per the time value of money. Now, what do we mean by historical cost? We already discussed historical cost is the cost associated with the year of purchase. If I purchase something in 2000, maybe some furniture, maybe some machinery that was purchased in 2000. So historical cost is the cost of that year. So that needs to be upgraded, right? There are many changes. There are inflation. There are upgradations in the machinery. So we are just taking basis as the historical cost that is not valid, right? So this is again the limitation, that we should consider changes in cost. We should also compare with the current market price, right? So we are recording transactions on historical cost, that is not taking into account the time value of money, that is not taking into account the inflation. So it is again the limitation of accounting principle, that we are ignoring time value of money. What is the present value of that machinery today? We are not recording that because we are running on historical cost. Number 3, only past records are accounted for, leaving no scope for recording any future events that might affect the business finance. I gave you an example that whenever I'm investing in advertisement campaign, say maybe I'm investing for rupees 5 lakh, for which will give me 5 big advertisements over 5 years. Now I'm recording that 1 lakh per year for every 5 years. That 1 lakh is recorded in this current year 2025, but that 5 lakh that I've incurred today will give me benefits in coming more 4 years, that is 2026, 27, 28 and 29, right? So I am getting these benefits from future events, but I am not able to record these future transactions or any decision which is just out of the financial year. Maybe the current financial year is 1st April 2024 to 31st March 2025. Suppose in April, I have certain event which I've launched, certain event related to my company that has to be occurred in April 2025. Certain event that is being launched, that is being introduced, that is being advertised, which will be happening in April 2025. But I am having benefits because of that event right now. That future event, which is out of my financial year, I'm having benefit now. I'm not able to record that future event within this financial year, right? But that future event is giving me benefits today, right? So that is again the limitation of accounting principle. And the last, in the case of accounting principles, form is given importance over substance. Explanations of substantial information is not given any importance. So accounting principle says that the main form, the main thing is given importance over the substance. The main explanations are not given any importance, right? We are just recording the transaction. What is the idea? What are the explanations? What is the whole thing behind when I'm, for example, I'm searching about my supplier, that which are the best suppliers for this raw material of my company. All this research, all this marketing, all this tie-up with the suppliers, all the schemes that we are going through in the purchase department, they are not being recorded. We're just recording what? We're just recording this, that we have purchased from supplier A, this amount of raw material. Whatever R&D has been done in finding out the right supplier, I'm not able to record it. So that is again the limitation of accounting principles, right? So these were all about the accounting principles, all accounting principles and the limitations. And now we will move to the journal entry. See, whenever we are recording the financial transactions, we need to have journal entries, ledgers, accounts, right? So we will start from what is a journal entry. Journal entry is an entry which is recording a financial transaction. Now, how we do, what things are involved, what steps are involved, we will just go through that. A journal entry shows when an account balance changes. What is the account balance? Whenever there is a debit, whenever there is a credit. Debit means what goes out. Credit means what comes in, right? You all must be having bank accounts for sure. You must have seen passbooks, and you must have seen that there is a debit side on left hand side and credit on right hand side. So credit means whenever your income comes, whenever you are receiving cash inflow, that is a credit. Whenever you are making payments, whenever your money is going, that is a debit, right? So whenever your account balance changes, we need to record that, right? Each change is entered as a credit or a debit, right? So either there will be a debit or there will be a credit. Either of it happens, we need to have a journal entry. In double entry bookkeeping, you make at least 2 journal entries for every transaction. These debit and credit entries are a bit counterintuitive in practice. So take the time to work out which is which. See, for example, I am getting salary, right? So I will have 2 journal entries related to it. Now, I will not tell you the journal entry related to it because we need to first understand what is debit, what is credit, what are the accounts we create, and then we will go to the journal entry. So first, let's know what is the primary purpose of recording the journal entries, recording transactions. Number one, every financial transaction is systematically logged, ensuring no event goes unnoticed. Right. So all financial transactions, again, all transactions that can be recorded in monetary unit in currencies should be recorded. Tracking activity. What is this? Journal entry helps in tracking the activity. It helps in recording. We are having the track of every debit and credit in our accounts. Journal entry provides a chronological record of all economic events impacting a business. Chronological means the date-wise record, right? January 1 में कितनी purchases हुई, February 1 में कितनी sales हुई. So as per the dates, we are having a record of all the financial transactions, all the economic events that impact the business. Next, facilitating audit trails. Obviously, when we have proper records, date-wise records in order, it helps in assisting the audit. They enable auditors to trace any discrepancies or anomalies back to their origin. Anomalies means any odd events, any discrepancies that have been recorded, they are easy to find out by the auditors. Back to their origin, ensuring financial integrity. See, auditors have the role to find out whether the company is going as per the track, being fair, ethical, true to the society, to the stakeholders, to the government, to itself, and they're not having kind of any unethical thing. Preparing financial statements. By ensuring accurate and consistent record keeping, journal entries directly from the generation of the income statement, balance sheet, and cash flow statement. So obviously, when we have journal entries, those general entries are posted into the trading account, P&L account, and balance sheet. So we have preparation of financial statements. Now, what are the steps to be followed to record business transactions in a journal? The steps are: number one, ascertain the accounts related to a particular transaction, right? For example, the basic example I will give you, purchase of raw materials. Now, this purchase of raw materials have two accounts. If I am not purchasing it on cash, I have purchases account, right? And then I have suppliers account from whatever supplier, from whatever company. For example, it is ABC company from which I'm supplying my raw materials, I'm getting my raw materials. So there will be two accounts. Suppose if I'm paying ABC company in cash for those raw materials, so it will be purchases account and cash account. These are the two accounts that will be affected, right? We will do properly in next slide, but I'm just giving you the example side by side. Find the nature of the related account, right? See, again, when I'm purchasing, so whether the purchase account is being affected or sales account being affected, which account is being affected, we have to find the nature of that related account. Ascertain the rule of debit and credit applicable to the related account. Then we'll apply the rule of debit and credit. Record the date of the transaction in the date column. Write the name of the account to be debited in the particulars column along with the abbreviation DR and the amount to be debited in the debit amount column. So first we will ascertain the accounts. Then we will find the nature of related accounts. Then we will follow the rule of debit and credit. Then we will write the date in date column, right? The date on which the transaction has been occurred. Then we will write the debit entry. And whenever we are writing the debit entry, in the end we summarize it with capital D and small r. This is the abbreviation we use for the debit. Next, then we will write the credit entry. Write the name of the account to be credited in the next line, starting with 2, and the amount to be credited in the credit amount column. I will show you one example like this. Before I keep on saying and it all creates a confusion, let's see this account. I'm not explaining entry, just see that this is a debit entry, cash or bank account being debited. Like this, we write the abbreviation. After writing the date in the date column, we write the debit entry with the abbreviation. Then this account also being debited. And then this third entry is the credit entry. We start with writing 2 and the nature of account, the name of the account, and that's it. For the credit entry, we do not use any abbreviation, CR or something, nothing. We just start with to and the name of the account, right? So this is how we proceed. Write a brief explanation of the transaction as narration, right? And in the end, we just narrate like this. Being business started with cash and assets. So this is basically the entry where we are introducing capital into the company. And when we introduce capital into the company, which accounts are being affected? If I'm introducing capital in form of cash and assets, maybe I'm bringing some new furniture or some machinery to my company. So two accounts will be affected. Two things are being brought by me. Those are cash, assets. So cash debited, assets. Why they are being debited? We'll do that later, but I'm just explaining you. Cash is being introduced, assets being introduced. So cash debited, assets debited, and capital account will be credited to capital account, right? And there is a brief explanation. Being business started with cash and assets. It is always below the credit entry and it is written in brackets and it starts with the word being. Being business started with cash and assets, right? Here we will have date. In the debit column, we will have the cash and assets amount, and in the credit column, we will write the amount against the capital account. Just a brief explanation. Now, why the cash is being debited, why the capital account is being credited, and why the assets account being debited, we'll do after just learning the rules of debit and credit, right? So that was the narration. The thing we write in bracket below the credit entry is the narration. Draw a line across the entire particulars column to separate one journal entry from the other. Now, this is a basic thing that we have to draw a line here for the next entry, separating one entry with the other. Now, these were the steps to record a journal entry. Now, we should learn the rule before starting or learning the recording of journal entries. First, let us understand what are assets, what are liabilities, and what is equity. We know in balance sheet we record assets and liabilities, right? Assets are on the right hand side, liabilities are on the left hand side. Liabilities are all the payments, and it also includes the all the short-term loans, short-term creditors, long-term loans, long-term creditors, like when we are issuing debentures, right? Those are long-term loans. I'm just giving a brief example, right? And liability side, we also include the equity, the investment in by equity shareholders. Whatever is our equity capital, whatever is our debt, whatever is our short-term credit, right? Maybe short-term loans and payments to be done, that are recorded on liability side. Now, asset side, we have fixed assets like furniture, plant and machinery. Then we have current assets. Then current assets have cash, stock. So whatever is the asset to the company comes on the asset side, that is on right hand side. Now, what does the debit and credit rule says? Debit is red, right? This means whatever is going out. It increases an asset or expense account. Whenever the asset is increasing or the expense is increasing, we will debit it, right? For example, cash is being brought to the company. The entry which we were just seeing, cash is the asset, right? Cash is the asset. It is being debited because it is increasing in the company. So whenever an asset increases or whenever an expense increases, right, that will be debited. Decrease in liability or equity will again lead to a debit. Credit means increasing a liability or equity and decreasing an asset or expense account. Now, I will give a basic example. If I am selling any furniture, right, that is an asset to the company. Furniture is being sold, so asset is being decreased. My furniture is being reduced, right? This means decreasing of an asset. Whenever I'm selling a furniture, whenever I'm selling an asset, it is decrease of an asset, it will be credited, right? Suppose the entry says selling of furniture worth rupees 50,000 at cash. So cash is again an asset. It is coming, so it will be debited. Cash account debited to furniture account, right? Let's do the entries and then we'll get to know So just remember this basic rule: debit what comes in increases an asset or expenses being increased, decreasing of liability or equity account. Credit means increases a liability or equity account, decreasing of an asset or expense account. Types of journal entries. Now there are various types of journal entries also. There is opening, there is transfer entry, there is closing entry, there is adjusting entry, there is compound entries, there is reversing entries, right? So we will see what kind of entries we have. Opening entries, it's very simple. The entries which we have to do initially when the financial transactions are being recorded. These are the initial entries that establish the opening balances in the various ledger accounts. See, we know that the company is the going concern, right? We will record transactions over and over again. Whenever one financial year gets over, we have a new financial year to start with. So on 31st March 2025, this year, we will be having certain closing balances that will be the opening balances for the next year, that is 1st April 2025 to 31st March 2026, right? So we will be having closing balances, maybe of cash, maybe of stock, maybe of some other inventory, right? That will have the opening balances in next financial year from 1st April 2025. So that will have those opening entries. These are the initial entries that establish the opening balances in various ledger accounts. Transfer entries facilitate the movement of amounts from one account to another, ensuring each transaction impacts the financial statements appropriately, right? So transfer entries is like this thing. Whenever I'm bringing cash to the company as capital, two accounts are being affected. Capital account is being credited, cash account is being debited. Cash, again, it's an asset increasing, so it will be debited, right? Capital is a liability, right? It will be credited. Then closing entries. Closing entries will be done on 31st March 2025, made at the end of accounting period to transfer the balances from the temporary accounts to the permanent accounts, right? Adjusting entries made before preparing the financial statements. Adjusting entries account for items that are not recorded in the accounting system at the period end. So there are certain entries which need to be adjusted, like made before preparing the financial statements. These are the entries which require certain adjustment, but they are not actually recorded in the financial statement. But we'll just learn about it. Compound entries like when we have more, we are just clubbing 2 or 3 entries together. It involves more than 2 accounts where there are multiple debits, multiple credits, or both. So the entry which we just saw, this was a compounding entry. We are having 3 accounts to be involved here: cash, assets, and capital. Reversing entries made at the beginning of the new accounting period. Reversing entries negate specific adjusting entries made in the previous period, right? So any entry that is just negating the entry which is done in the previous period, that is called reversing of entry, right? We are just reversing it. That entry is called reversing. It will be made in the beginning of the accounting period. It will be reversing the entry. It's basically reversing entries negating the specific adjusting entries made in the previous period. So whatever entries made in the previous period, to negate the effect of that, we will be making the reversing entry, right? Now we will talk about specific ledger accounts. These are capital accounts, drawings, expenses, income, purchases, sales, purchase returns, sales return, stock, cash, credit. These are the ledger accounts, right? These are the ledger accounts, and all these ledger accounts have certain specific entries, right? Maybe opening entries and then further adjustment entries. We will learn how to do these. What is capital account? The amount invested in the business, whether it is in terms of cash or kind. Kind means whenever the owner or anyone who is participating as a partner in the company is bringing certain asset along with the cash, or only the asset, that is called kind, by the proprietor or owner of the business is called capital. The capital account will be credited and the cash or assets brought in will be debited. I repeat, the capital account will be credited, and the cash or assets brought in will be debited. So cash or bank account debited, assets account debited to capital account. Being business started with cash and assets, right? Next is drawings account. Drawings means whenever the owner of the company is drawing from the company, right? Withdrawal of any amount in cash or kind from the enterprise for personal use, right? Drawings are always for the personal use, then only it will be recorded in this way. Withdrawal, if it is for the office purpose, it will not be recorded. Withdrawal of any amount in cash or kind from the enterprise for personal use by the proprietor is termed as drawings. The drawings account will be debited and the cash or goods withdrawn will be debited. So drawings account debited to cash account to purchases account. See, cash is being reduced because drawings are being done, right? And it will be credited. If the goods are also withdrawn, for example, we have purchased something, certain raw materials, certain things, and if those goods are also withdrawn from the company, the final products of a company that are also withdrawn from the company for the personal use, then purchases accounts are also credited, right? Being cash and goods withdrawn for personal use. Expenses account. Any amount spent in order to purchase or sell goods or services that generates revenue in the business is called expenses. For example, we are paying electricity, we are paying rent of the warehouse, right? These are the basic expenses. We are paying salaries to managers. The cash account will be decreased, right? So whenever asset decreases, it will be credited with the amount paid as expenses. And whenever expenses are being increased, increase of an asset or expense, it will be debited, right? Decrease of an asset, it will be credited. So expenses account will be debited because expenses are being increased. Increased means we are actually paying towards expenses, right? Those expenses are being paid or we are paying something towards expenses, they will be debited. And cash, the asset is being reduced, that will be credited as per the debit credit rule, being expenses paid in cash or with bank, right? Next is income account. Any monetary benefit arising from the business can be termed as income. The cash account will be increased with the amount received as income, so it will be debited and income account will be credited. So income means incoming of cash. Incoming of cash means increasing of asset. Asset being increased, cash, it can be received in cash or it can be received in bank. So that is why we have written cash / bank account being debited, right? Because we are receiving the income. Now, what can be the income to the company? We are not talking about our income. We are talking about income of the company. Income can be of the company when if we have put certain of our warehouses to rent to someone else, to the third party, the rent received is the income, right? Or any other insurance income received. The incomes of the company are very limited, but yes, cash or bank account debited to income account, right? Next is purchases account. Now this is the important account which we should consider. When goods are purchased in cash or credit, donated, lost or withdrawn. See, sometimes company not only purchase on cash or credit, it also sometimes donate whatever they have produced. Or sometimes the good is lost. How they are lost? Due to fire, due to accidents in go down, right? They needs recording too. Or they're withdrawn for personal use. In all these cases, goods are denoted as purchases accounts. So whenever we are purchasing goods, whenever we are purchasing on cash or credit, whenever we are donating them, whenever it's lost due to accidents in the company by nature's action, or whenever they are being withdrawn for personal use, right? They are recorded and denoted as purchases accounts. Now we have 4 entries related to it because of the 4 different kind of transactions. First journal entry says goods purchased for cash. Now whenever I'm purchasing goods for cash, cash is being reduced, so it will be credited. Asset being reduced is credited. And I am having purchases, my expenses are increasing. Purchases are my direct expenses of the company, so they are being increasing, so I will debit it. Purchases account debited to cash account with a brief being goods purchased in cash. We have to mention this, being goods purchased in cash. If we do not mention these two words in cash, we cannot specify whether the goods were being purchased on cash or in credit. Of course, we can see with the entry, but these briefings work well, right? Then we have goods donated, donation account debited to purchases account. Now, whenever we are donating our products, there is like reduce of our goods. Whenever our goods reduced, whenever a stock is reduced, whenever the asset is being reduced, it will be credited. So purchases account is being credited and donation account is being debited, being goods donated. Then goods are withdrawn for personal use. These are already done by us, but we'll still repeat. Drawings account debited to purchases account, right? Again, goods stock is being reduced. Whenever asset is being reduced, it is credited. Then goods lost by fire. Lost by fire account debited to purchases account, right? So these were all the entries related to purchases account. Again, we will write this brief summary, being goods lost by fire. Then we have sales account when goods are being sold, right? Now, if they are sold on cash, it is cash account or bank account, right? Whether if I'm receiving, goods are being sold on cash, but the amount is received in our bank account, maybe SBI Bank, whatever ABCD bank, right? Then we will write bank account debited to sales account because our amount is directly being received in bank. But it says that goods are being sold on cash, we will only mention cash debited to sales account, right? Now, when we write this term debtors, whenever we are not having sales on cash, when we say goods are being sold to ABC company, there's nothing mentioned whether any cash is received, whether any check is received, nothing is mentioned, right? It's just say that goods are being sold to ABC company. So ABC company is our debtor, the company who will pay us later, right? So ABC company account debited to sales account. Being goods sold in cash or bank if it is sold on cash or if the check is received. And if it is sold on credit, we will just write being goods sold on credit. We will skip this. So either of this will come, right? We have just clubbed the summary in this. Then purchase return or return outward account. When purchased goods are returned to the supplier, it is denoted as purchase return account or return outward account. Return outward account means whatever is going out. See, suppose we have purchased certain raw materials from supplier A and I find out of the lot of 10 boxes, 2 boxes of my raw material are not up to the standard, up to the quality. I want to return those 2 boxes back to the supplier A. So I will create purchase return account or return outward account, right? When purchased goods are returned to the supplier. Now, whatever is the supplier's name, that will be debited. Supplier account debited to purchase return or return outward account. See, whenever we were making purchase, it was purchases account debited to cash. Or if I was purchasing on credit, it was for cash. If suppose I purchased goods on credit, it was purchase account to, if my supplier name is supplier A, the entry would be purchases account debited to supplier account. Right. Now, supplier was credited at that time and purchases account was debited. Now this is called reversing of the entry, right? Now we will reverse the entry. Now the supplier account will be debited in case of purchase returns and purchase returns account will be credited. See, supplier account debited to purchase return or return outward account, being goods returned to the party. Date here, amount to be debited here, amount to be credited in next line here. This LF means ledger folio. See, every ledger, these are the ledger accounts. This supplier, this purchase, return, purchase, capital, all are these ledger accounts. These have separate ledger folio numbers and the accountants have the duty to write these respective ledger folio numbers along with this. So if you see in every account we have this, every journal entry we have this ledger folio, right? Now we have sales return or return inward. See, return inward means whatever is coming to the company. So this is how you can recall what is return inward or return outward. Return outward means going back to the supplier. Return inward means coming back to the company. If I'm selling something to my customers and customer B says, my lot is not good, I want to return this thing to your company. So that is return inward account. So whenever we were having sales account, sales transaction, it was like debtors account debited to sales. Now this entry will be reversed. Sales account to sales return or return inward account debited to debtors account, right? Sales return or return inward account debited to party's name. Party's name is the debtor. Why I'm saying debtor, because if we would have sold the goods on credit, if it was sold on cash, then also we will write the party's name only here, right? Stock account. The leftover unsold goods at the end of the financial year is represented through stock, right? So obviously whatever goods are being produced, whatever finished goods we have to be sold in this financial year, it's not 100% not that we will be able to sell all of them, right? So we will be having a certain closing stock which have closing entries. So recording of closing stock is related to closing entries. The leftover unsold goods at the end of financial year is represented through stock. Closing stock is the valuation of goods left over at the end of a financial year, and opening stock is the valuation of goods at the enterprise that has at the beginning of financial year. So whatever valuation we are doing at the end of the year of the unsold goods, that is closing stock. That closing stock entry will be only on 31st March 2025 for the current financial year, right? And that closing stock will become opening stock on the next day itself, that is 1st April 2025. So closing stock, obviously closing stock, whenever we are valuing stock, it is like increasing the asset. So increase of asset means debit. So 31st March 2025, closing stock account debited to trading account, being closing stocks transferred to trading account. Cash account. Now there are certain transactions it's just like repeating of purchase and sale transactions given, but there are other transactions also involved in cash. It's the ledger we are discussing, cash account ledger. Cash transactions, only those transactions which are done in cash. They are recorded, whether the payments are being made, whether they are being received at the time of purchase or sale of goods. Cash transactions can be identified when the name of the party and cash both are given in the transaction. When only cash is given in the transaction, when the name of the party and cash both are not given, right? So we are saying if in a journal entry it says goods being sold on cash, we can record, though there is absence of the name of the party, right? Even if the name of the party is not being mentioned, we can record that transaction. How? Goods being sold on cash, cash account to sales, cash being received, asset being increased, and when asset increases, it is being debited, right? Now, when the party name is also mentioned, it is the additional benefit. Goods being sold on cash to ABC company. Okay, but the entry will not change because the sales are being done on cash. When nothing is mentioned, but it's like goods being sold and cash is received, yeah, whatever, then also it will be same entry, cash account debited to sales account. And this is for the purchasing. But what are the other entries we can think of? Like rent is being paid. So rent is an expense. When expense is being increased, it is debited. When cash is being decreased, asset is being decreased, it is credited. So rent account debited to cash. So make a simple rule. Whenever is cash going out, it is to cash. It is being credited, right? And whenever is cash coming in, whether it is form of income, sales, whatever, rent being received, so it will be cash account debited to rent account, right? So whenever cash is coming, cash account debited. Whenever cash is going, it is to cash. This is the simple rule of cash account. Credit transactions. Credit transactions are those which are not being done on cash. It is done on credit. When payment is not made or when payment is not received, right? Either at the time of purchase, payment is not made. Either at the time of sale, payment is not received. We relate it to as credit transactions. Now, what are credit transactions? We need to have the name of the credit transactions can be identified only when the name of the party is given. How we will record? Agar party ka name hi nahi hoga, how we can do the recording of those journal entries, those financial transactions? For example, I am selling goods on credit to ABC company. So it will be ABC company account debited to sales. I am purchasing from XYZ company. So purchases account debited to XYZ company. I'm again repeating, purchases account is being debited because it's a direct expense. Expense being increased, it is debited. Sales account, sales is a direct income. So when income increases, it will be credited. Now, we have assets account. Assets account are like machinery, building, land. These are fixed assets, right? We have current assets like cash, stock. So basically, machinery, building, land, those assets which have heavy investments, right, which cannot be easily sold. These are long-term assets, right? These are fixed assets. And we also have assets as current assets that can be easily converted into cash, like stock and cash. Now, assets can also be purchased or sold in cash or on credit. It is not represented through purchases, but with the name of the asset, right? Whenever I'm purchasing asset, whenever I'm selling asset, it is not purchases, it is not sales. We mean to say that. Asset is being purchased, it is recognized with the name of asset account. Asset being sold, it is recognized with the name of asset account, not with the sales account. So when assets are purchased, asset account, whatever asset being purchased, for example, machinery is purchased. So machinery account debited. Why? Because machinery is increased. Asset is increased. Whenever asset increases, follow the debit rule. We will debit when asset is increased. Now, if it is purchased in cash, to cash account, cash is being going out. When it is purchased on credit, to party's name account, right? So assets purchased in cash or on credit, right? This will be the entry like this. Assets sold, cash is being coming in, right? When assets are being sold, or if it is sold on credit, that payment on asset being sold on credit means the payment will be received after some time, not immediately. So for that time being, till the time we receive the payment, what we will do, we will record the party's name. Party's name debited to asset account. Asset is being decreased, so it will be credited, right? Then we have depreciation account, right? We know all the fixed assets have wear and tear. They need to be depreciated over the time so that true value of theirs can be recorded. So depreciation is decrease in the value of assets due to use or normal wear and tear, right? Depreciation is an expense being debited to asset account. Right? Assets are being decreased, the value is being decreased, so they will be credited. Then discount allowed and discount received. See, discount allowed is when I am selling. We are allowing the discount to the customers. We are giving certain discounts when we are selling them. Discount received when I am purchasing from the suppliers. I am getting certain discounts. So a discount is a concession in the selling price of a product offered by a seller to its customers according to it's a concession in the selling price of a product offered by a seller to its customers. So it's a general term we are saying. A discount is a concession by a seller to the customer, right? According to nature, there are two types of discount: discount allowed and discount received. Discount allowed when I am being seller. Discount received when I am being purchaser. So discount allowed when at the time of sales or receiving cash, any concession is given to the customers, it is called discount allowed. So when I'm selling goods on cash, right, and I'm giving discount to my customers, so cash account debited for the actual amount of cash being received. Discount I'm giving to them debited because discount is basically my indirect expense that I'm incurring, right? I'm giving discount, so it's my expense basically. It's reducing my sales value. To sales account, sales is my direct income, so it's increasing. It has to be credited, or if it's being done on credit, to party's name, right? Being cash received and discount allowed. Now for discount received, purchases account debited, party's name account debited, to cash account to discount account. When I'm making purchases from my supplier, if I'm doing it on cash, right, I have to pay cash. Cash is being decreased, so it is credited. Discount is my indirect income when I'm purchasing the goods when I'm purchasing my raw materials and I'm getting discount, it is my indirect income. So it is again being credited to cash to discount account, right? Purchases account being debited, it is my direct expense. Expense increases, it will be debited. Or party's name. When this party's name comes, when I'm purchasing it on credit and still I'm getting the discount. Okay, that's all for today. We will continue with the tally thing in the next session. Any doubts? Any doubts? I can, if I have to check.
Yeah, hi, Ira.
Yeah, hello, sir.
Hello. There is a question.
Yeah, there's
One question has come. What is the difference between materiality and reliability principle? Both principles have similarities that only material transactions need to record. Ma'am, can you please explain difference in between them?
Yes, definitely. See, materiality principle means whatever is material to the organization. Material to the organization means there are all the transactions which hold material value. See, we already discussed in the last class also that petty things which are very much petty in nature, small in nature, minute in nature, they are sometimes not recorded or they are clubbed together, right? So material means all those transactions which are very much material, which hold true value to the company, that should be recorded, right? Which has materiality. Immaterial transactions, though they are monetary in nature, they are ignored. Reliability principle means that they should be verified with the proof of evidence. They should have the evidence. Right. So though both principles have separate meanings, they are talking about a financial transaction, but from different point of view. Materiality principle means that we should try to record all those financial transactions which are material to the organization, which are material in nature. And reliability principle means that all the financial transactions which can be verified with proof of evidence, right, they should be recorded, which can be matched with the proof of evidence. So both angles are different. Is it clear, Mr. Akshay, or should I explain more? Audible?
Yeah, I think no, ma'am, got the difference. I think he understood.
Yeah.
Yeah. So, what we are going to learn day after tomorrow?
We will be doing Tally Basic.
Very good. So, get ready for tomorrow. So every alternate day we will have class, the same timing, 9:45 in the morning.
Right.
So I will share the link to myself so that all of us join day after tomorrow. The day after tomorrow is Thursday.
Yes.
So class on Thursday and then on Saturday. And thereafter we will have another class on Monday and likewise.
Right.
So thank you, Ira, ma'am. Thank you for your time.
Thank you so much, sir.
Yeah.